Hello everyone, welcome back. Welcome back to the chat room. This is Ed Ponzi speaking to you. Today is July 11th. It's Friday afternoon from the lovely Jersey Shore, East Coast of the United States, speaking to you today. Just flew in from Los Angeles. I'd say it always makes me smile. Palm trees and sunshine and, nothing but good things. So anyway, it's good to have that done. And a shout out to Rick, who had some root canal surgery, but he's in there producing this event. Thank you, Rick, for hanging in there and hanging tough. And it's been a crazy week for everyone around here, but we're getting caught up here as we wind down the end of the week. And I'm going to start off with the S&P 500 because I actually had a question from one of you about the S&P 500, and it's not a stock question, it's really a currency question. And a friend of ours from South Africa asks, what will happen to currency pairs if there is a steep decline in the stock market? What will happen to pension plans? I don't know what to expect should that happen. Well, first of all, don't panic. I'm not looking for a steep decline. The thing that I was pointing out last week, if you recall, or perhaps it was the last session, I'm honestly not sure at this point, but the thing that I've been watching is the 150-day moving average. So it's a simple 150. We don't trade off of it, but it's notable because the S&P 500 has been using that for support. And I think the last time we said that every time it gets very far extended above that moving average, it has a tendency to pull back. It doesn't just turn straight up and run away. It has a tendency to come back to the moving average. You can see that happening, more or less. Sometimes it doesn't make it all the way down to the moving average, but, generally speaking, it gets stretched by a certain amount, and that's as far as it's like a rubber band. It snaps back. And now we're kind of at that point where that rubber band is a little bit stretched. So it doesn't necessarily mean that anything bad's going to happen. I mean, to be honest, this looked like something really bad was going to happen here back in January. And what happened? Boom, we shot higher. And then in April, things looked really bad and we shot higher. But I'm kind of expecting at least a pullback to this area. Okay, I don't think it's just going to turn and go straight up. And it's normal, healthy market behavior for markets to back up and to back and fill. Now backing and fill, what's backing and filling? Backing and filling is like, okay, it comes up and it goes back down and it fills that space in. It goes up and it comes back down and fills that space in. Backing and filling. And what backing and filling does is it creates support levels. So if the price does fall, let's say the price breaks that moving average, that's going to be your support level right there. See that area? Right across. And then there's this one right here around 1750. So you're going to have it like a little bit above 1800, a little bit below 1750, so on and so forth. It creates levels. When prices move straight up and down, they don't create levels. They don't back and fill. They don't create levels, and that makes them easier. It makes it easier for the price to move. Now, we use that to our advantage. One of the reasons why we like the pound yen is precisely for that reason. And this has pulled back on us. It's basically back to our entry point. No win, no loss, just hanging in there. But you see how there was no backing and filling here? This pretty much goes straight down. I really like that because I'm looking at this area here, especially from here to here. There's no backing and filling. Pound yen just moves straight down. So there's no resistance from here to here, and that could make it easier for pound yen to move straight up. Okay, so that being said, let's get back to the question at hand. What's going to happen to currency pairs? Well, they are definitely interrelated. Now, two things. The first thing is this. A lot of people were worried about Europe and a banking crisis in Portugal. This is stuff that this was all supposed to be over with, right? This was all supposed to be behind us at this point, banking crisis, etc. That's all supposed to be over and done with. But you know what? Apparently it's not, okay? There has been an issue that popped up this week in a Portugal bank, and the thing is like banks are very much interrelated. They lean on each other, which is what made that financial crisis so bad back in 2007, 2008, was their interrelationships. They lend each other money, right? So you know, if one of them goes under, it's going to put pressure on another one that, you know, that loaned them money. They loan each other money all the time, and if they can't pay it back, then it's going to spread. The problems could spread. So right now, I think the market is telling us that the problem is not about to spread. Here's why. By the way, that used to be one of our targets, right? Remember that? Is that not a support level now? Isn't that amazing? This was support back here, 135.90. That's why we used it as a target. We got in long here. We use it as a target, and 135.90 is once again acting as support. But I find this to be good in the sense that I'm not trading the euro right now, so it's neither here nor there as far as trading is concerned. But this is telling me that the market is not really worried about Portugal. The market's not really worried about that Portuguese bank, because if it was, what would be happening to the euro right now? And if the market was really worried, the euro would be falling. And it's not. It's hanging in there. It keeps finding support. Now, if that breaks support, and really what would really make me nervous is, you see that 135? If it broke this diagonal line and then broke 135, obviously we'd be in trouble. Now, that's only 100 pips. And you know the euro used to move 100 pips on a day on average. On an average day, it would move 100 pips. But right now it doesn't. Right now it moves less than 50 pips on an average day. So, you know, I think the market is saying, look, we understand that the potential for a problem here, but we are not panicking because at this point it does not appear to be contagious. It does not appear to be a contagious situation. Okay? So anyway, that's the scoop for that. And now, as far as the other currency pair I'll be watching here is dollar yen. The other currency pair I'd be watching here is dollar yen. Dollar yen, right, finding a lot of support here, 101.20. And you can see that area, that line's been in place for a long time. It actually goes back to here. It goes back to July of last year. So we've been using that line since July of last year. It acted as resistance. Here, I'll change the color so you don't get confused. I'll make that one blue. That was resistance here, and as it comes across, now it's been support all year long. And with the big support level, 100.80, another 40 pips below. But lots of support at 101.20 for dollar yen. Do you see the way this came down? This reflects some concern. The yen getting stronger reflects concern. So the euro's not worried. So maybe it's not the European bank that has the market worried. What else could have the market worried? See, what we're really doing here, if the market was worried about the European bank, about the Portuguese banks, the euro would be falling. It's not. But the yen is definitely rising. So what I take from that is the market is worried about something, but it's not necessarily what everyone else thinks it is. The market is worried about something, but it's not necessarily the Portuguese bank. I think they're worried about the economy in general. Now, you know that in the first quarter, U.S. GDP was only, well, it was negative 2.9, incredibly bad number. And worse than the worst estimate. The lowest estimate was negative 2.4. We came out at negative 2.9. So the feeling was, you know, stocks just kept going higher in the face of this. Why? Because the stocks were saying, you know, it was all weather related. The economy's good. The economy's expanding. The economy's growing. So it's all good. A little bit of bad weather. Well, a lot of bad weather, let's face it. And you know what? If you cannot get out of your house or you cannot get your car out of your driveway, think about it. Then you cannot buy a house. You cannot go to the mall and go shopping. You cannot buy clothes. You cannot buy a car. You can't buy anything. And so, okay, we forgive first quarter GDP. But the problem is, okay, if people could not buy what they needed in the first quarter, they should be buying it in the second. Is that a fair statement? They couldn't buy it in the first quarter. They should be buying it in the second quarter. Now, one of the things that is of a concern to me is, are people buying what we would like them to buy? For example, you see, companies report earnings every 3 months, but retail stores report their sales, their same-store sales, every month. So if I think about Walmart same-store sales, right? Walmart same-store sales, should be going up because people couldn't get to Walmart earlier, right? They couldn't get to Walmart in the snow, but now that the snow's all gone, right, they couldn't get to Walmart in July, February, and March. And I use Walmart as an example because that's the world's biggest retailer. So they should be pumping out the sales right now. They should be selling a lot of stuff because all that stuff that people could not buy in the first quarter, they could buy it in the second quarter. Instead, they've lowered their outlook. They've lowered their profit outlook, same-store sales. It doesn't look good. There's some negative announcements came out of Walmart this week, and Walmart's not the only company, right? But sales have definitely stagnated at Walmart, and this is a big problem. And it's not just Walmart. So now you're saying, this economy was so slow earlier in the year, it should be picking up, and it's not. Lumber Liquidators, I believe, was another company, made a very similar comment. Well, people just aren't coming in. They're just not coming into our stores. Okay? So what does that tell you? Maybe it's not just the weather. Maybe there's more wrong than just the weather. And interest rates, of course, you don't want to fight the Fed. Stocks have a very hard time going up as the Fed starts tightening. Now, the Fed's not tightening yet, but the Fed is scheduled to start tightening when? Well, Janet Yellen gave us a roadmap. We know that Janet Yellen has already told us that approximately 6 months after the Fed is done unwinding QE, rates could start going up. So that would be around springtime of next year. That's getting closer. Markets won't wait for the rates to go up to react. Markets will react in anticipation of rates going higher. Okay? So all these things playing in together, you'd be foolish not to be concerned, but at the same time, you can't really fight the trend. So we still have our longs in place, but we've added some shorts and we've trimmed our longs, and we've gotten a much more balanced look to our portfolio. We were very aggressive up until recently. Now we're much more balanced. And as far as the currency pairs are concerned, well, you can see like pound yen, we were up nicely on this, and now we're just breaking even, which is a little disappointing, right? Maybe more than a little disappointing, but hey, we're not losing money here. Our stop's way down here. We might be in this one for a long time, gang, but the euro yen is one that I've got my eye on here, and I believe we talked about this. This is trying to break down here. Push that line down a little bit. It's trying to break. It actually got under that line yesterday. Euro yen could be setting up as a short here, but again, this big red candle, that's more yen strength than euro weakness. Okay? All right. Now, so anyway, we'll flip through some currency pairs very quickly, but the fact is nothing much has changed since the last time, and I've been jetting around the country this week. I was out on California for 3 days. I just got back. We haven't placed any fresh trades, so if you notice, if things seem a little bit quiet, it's because they are. But we are in that summer doldrum time. Markets have been fairly quiet, and you don't want to go chasing after things that aren't there. I will tell you this, though. Aussie, interesting action here. It's having an awful hard time with this resistance level up here. You had the false breakout, turned into a fake out, shot right back down. It's having an awful hard time here. So this one Doesn't seem to have a direction to it. I mean, I'm thinking it's eventually going to go higher, but right now it's telling you that it's not time to buy it yet. New Zealand yen is trying to break through this final resistance level, and again, it's like pulling teeth. You've got bull flag, bull flag, bull flag. It can't just seem to get out of gear. But above 88, it becomes, if it breaks that final line, then you're talking about major new highs. What will happen, though, is this. If New Zealand does break out to new highs and gets above 88, let's say New Zealand gets up to 90, what do you think the Central Bank of New Zealand is going to do? We already know they're raising interest rates. What else are they going to do? They're going to jawbone, and they might intervene. You know, the Reserve Bank of New Zealand did do an intervention earlier this year. It didn't really draw a lot of attention because they were very quiet about it. They didn't jawbone ahead of time the way, it's the way some central banks do. For example, Japan, most notably, jawbones a lot before they'll make a move. New Zealand sort of very quietly did some intervention. So you could see that here. So don't get carried away with the technicals here. I know the technicals look good for New Zealand, but I'm telling you, when this thing breaks out, if it does break out, they will try to push it back down, and that's going to make life very, very difficult for people who buy it. It's not going to be an easy ride like some people might believe. Okay. Euro USD, again, I'm not a buyer here. It has to, if it comes back down to that line, I'll take a look at it. But that's not something I'm interested in doing right now. Now, by the way, if that dollar yen does break down underneath that black line, it probably takes the stock market with it. So I just want to make sure that I answered our question from our friend in South Africa. The currency pairs in the stock market would decline together. So what would happen to the currency pairs? Dollar yen would decline sharply, I think, if the stock market would take a hit. And in fact, if this breaks 100.80, I wouldn't be thinking short dollar yen, I'd be thinking short stocks. Right? That's sort of an intermarket analysis. Right? I would be thinking more about shorting stocks than I would be about shorting this currency pair. Euro yen, I think we said earlier, Euro yen looks like the better setup for a trade if this breaks. And we've come very close to breaking. It's about 137.90. Traded beneath it yesterday, but it just doesn't seem to want to give way. So it's very frustrating going right here. And I would say to you this: don't force it. All right, we're not forcing things over here. We're not trying to force something to happen. You've got Janet Yellen coming up soon. Let's take a look at the calendar. There's a lot coming up. So obviously GDP is something I have on my mind. We already spoke about that, right? Janet Yellen I also have on my mind. You're going to be hearing from Ms. Yellen in her testimony next week. There's definitely a risk here. And by the way, I'm going to pull up the Forex Factory. This calendar is awesome. We're just going to pull up some U.S. data here. Okay, and apply that filter. And if I take you ahead to next week, Fed Chair Yellen testifies Wednesday the 16th, also Tuesday the 15th, same time. So this is the way it works. When she's on Capitol Hill, she does two, right? One in front of the Senate, one in front of Congress, one in front of the House of Representatives, rather. And, that I would watch very closely. I would not be too surprised if she says something disappointing about the U.S. economy. And if she does, that could be the catalyst for everything that we're talking about. That could be the catalyst for a breakdown in the dollar yen. If she admits, or not even admits, but if she notices or hints even that the economy is weaker than previously expected, that's what could cause that dollar yen to break down, and that's what could finally cause the stock market to pull back. Now here's the thing. The market, dollar yen might break down. The stock market might not, though. I mean, markets could perceive that if things are weaker than expected, that we're actually going to get more stimulus. Maybe they keep quantitative easing going longer. But right now, that's not a popular decision. After all the quantitative easing that we've seen, prices are finally beginning to move up, but really the economy isn't that great. And you might have noticed gold, which we are long, and we call it right here in the room, gold is beginning to move, isn't it? We saw that big move up was a big sign to us here. And there was very good volume on gold at that point. Right, very big volume move up here. And that was telling us something. But what else is it? It's the same thing I've been telling you guys forever. Seasonality. Beginning of the third quarter. There's a tendency for gold to get strong at the beginning of the third quarter. Guess where we are right now? We're 11 days into the third quarter on a calendar basis. All right, and guess what started happening right before the third quarter began? Gold began to move up. Okay, now the last time, here you go, third quarter of last year, we were right down here. It begins almost exactly on the first day of the third quarter. Boom, 2 months of pretty much straight up activity. And if you want to go back further, we can go to July. Is it July of the previous year? It didn't really do that much right there. Here it is, July of 2011. Explosion higher beginning when? Beginning of July, which is the beginning of the third quarter. Gold explodes high here. And so it doesn't happen every year, but there's been this weird tendency, and frankly I haven't heard anybody else talking about it, but there's been a weird tendency for gold to take off at the beginning of the third quarter. And if it happens this year, it'll be the third time out of the last 4 years that it happened. And why that would be, I don't know. The fundamentals of gold are frankly perplexing to me because, you know, very often it seems to move intuitively to its own fundamentals, or it seems disconnected from its own fundamentals would be a better way of putting it. So I'm not too keen on, I don't even really worry about gold's fundamentals. I just look at the technicals. Because to me, the fundamentals don't really give you an edge. And there's a lot of bad information out there about gold too. Be really careful. I'd say, like, there's a ton of businesses out there that are predicated on selling gold to you. And in order to get you to buy gold from them, they have to convince you that you should buy it. So there's all this wacky news that comes out from these, you know, strange websites telling you reasons why you should be buying. But the only thing I'm worried about is the chart. I don't really care what anyone says. I only care about the chart, and the chart says you got to buy. Okay. All right. So we're in, and hopefully you're in too. We're not long gold, by the way, per se. We are long the Spider Gold Trust, that's symbol GLD. It's basically an ETF, an exchange-traded fund that mirrors the price of gold, so it moves along with the price of gold. Now let's talk about some stocks individually. We still have half position in Apple, which has done surprisingly well for us. It's still hanging there at 95. That's very close to an all-time high. If I take you to the weekly, look how close you're getting to your all-time high. It's basically $100 is the all-time high for Apple after that 7-for-1 split. Getting close, and I like the way it's trading. You know, it doesn't seem to pull back very much. Here's Amazon. We still have a half position long in Amazon. Amazon's having a big day today, and it's breaking out. It's finally breaking out of this inverted head and shoulders. You see we had to make that right shoulder a little bit longer. But kaboom, right? Big day, but where's the volume? You see, where's the volume? Average volume is 3.5 million. It's currently less than 1.5 million shares traded. So, yeah, I'm long, but I'm not as long as I used to be. And I got to tell you, I'm not that impressed with the move. It's happening on. Look, it's Friday trading in the U.S. Friday summer trading tends to be light volume. I'd rather see it move up than down, you know, because I'm long. But on the other hand, I'm not that impressed with it. Starbucks is, you can't really complain about it. It's done nothing but go up for us. We are out of Celgene as we told you, and it's still pretty strong. It's still hanging in there, but we didn't want to be too far out over our skis in case things did pull back. We are out of Celgene. We are out of ISIS, pharmaceutical stock, not the other organization. Okay, and as far as shorts are concerned, Lulu, textbook, man. It hit that 50-day moving average, which was right on that line, and it's pulled back down. We entered short at the green line, so we're making a little bit of money there, not a lot. TJ Maxx, actually, we're down slightly on TJ Maxx. We shorted on the break of that green line right about here, and it moved down. It shot back up. Firstly shot it back up, but that is like a bear flag. You see how that's kind of a bear flag move? Or anyway, even if you don't want to consider that a bear flag, you'd have to say it's lower highs, right? Lower highs and lower lows equals a downtrend. And when the stock market's hitting, recently hitting all-time highs and your stock's in a downtrend, there's probably something wrong. So TJ Maxx we don't like, Lululemon we don't like. We covered Target because Target was beginning to look kind of chirpy there. It was, starting to break out above some key moving averages, forming lower highs and lower lows. Not the type of stock you want to be short, so we let it go. We got out. We took like maybe about 6% profit, though. I mean, it was not a bad trade, but do you think I wish I would have gotten out down here? Yeah, I definitely wish I would have gotten out down here. Okay. No need to. No, don't worry about that. Yeah, I'm very well aware that that this was a pullback to support, and I should have covered my short there at 56 instead of covering it at, in the 59s. Okay, kicking myself for that one, ladies and gents. Yeah, it still happens. What are you going to do? We have some JCPenney, by the way, also on the long side. Nothing's happened here. It's not going up. It's not going down. But I'm thinking that if they have a good earnings report, that the analysts will start to upgrade it, and that'll draw some attention to it, some positive attention. So I see that as a possible occurrence that could be coming our way. All right. Okay. So listen, gang. Moral of the story out there: don't push it. It's summertime. It's in the U.S. It's slow. It's summertime in Europe too. I know some of you folks are out in Europe, and it's where most of us are located. Markets are slow right now, and if you don't learn patience, if you can't practice patience, the market will punish you for it, and it'll teach you to be patient. If you're going to run around and try to make something happen when nothing is there and try to force the issue, you'll soon find out why that's a bad idea. And speaking of bad ideas, there's one thing that I wanted to mention. This stock everyone's been talking about, but thankfully none of you have asked me about this. Cynk, C-Y-N-K, and it's been quite the story. This is a stock that it's been so bad for so long that it barely registers. I don't know if you can see it, but there's little candles down here. The stock's trading at 8 cents here. April, right? 8 cents. May, mid-May, 6 cents. 6 cents a share. Then one day, now I'm going to try to get the day before, it jumps up, it's like 16, it goes up to $1, and then boom, one day it goes from like 16 cents, it opens at 18 cents, goes down to 10 cents, it's $4.25 and closes at $2.25. It's a ridiculous gain. And before you get excited about this, and you can see the way it's moving, I want you to be understanding one very important fact here. This isn't even a real company. Okay? If you're tempted to buy and sell stuff like this, if you look up the fundamentals on CYNK, this is a company that has no income. There's no reason for this to be going up. Okay, it's just that I think people they don't know what to do. They're greedy. They're dumb. If you're tempted to buy this, you must immediately go to Netflix or wherever you get your movies and watch the movie Boiler Room. Boiler Room. If you are trading CYNK, you must watch Boiler Room. This stock, this is going to end in tears for someone. In fact, it may already have ended in tears. The date of that trade is 7/10. So yesterday it closes at $13.90 a share. Today, $10.03. But actually, I'm hearing that it's actually 20 cents. It's gone back down to invisible. So instead of making that mistake and paying for it with your own money, read about this stock. Go on to Google, type in CYNK, and read all the stories about it, especially anything by Herb Greenberg. Herb Greenberg wrote a few things about it yesterday. This is a complete piece of junk, but it started to go up, so people started to buy it, and they're going to lose all their money now. Okay, so don't make that mistake. Do not get involved with penny stocks. If you're at all tempted to trade nonsense like this, you must watch the movie Boiler Room tonight. Okay? All right, gang. That's going to do it for me. My name's Ed Ponzi. Thank you for listening, and I'll see you back here again very, very soon. Everybody take care.